Extremely happy to be joined by Neal Berger of Eagle View Capital Management. Neal, great to have you here. How are you doing?
Thank you, Jack. I'm well. Thank you for having me.
Glad to hear. So, Neal, you've been in the hedge fund business for a long time. I want to hear about your journey, but I also want to hear about the absolutely exemplary performance that you had last year. You launched a contrarian macro fund within your suite of funds in April 2021. And that fund for the year of 2022, when the S&P 500 was down, the bonds were down, everything was down, crypto was down, that your fund was up 163%. So I want to say, number one, congratulations. And I want to know, how do you do it?
First of all, thank you. Second of all, as you said, everything was down and we bet that everything was going to be down. So that's a simple answer as to how we did it. I can elaborate a little bit more as to why we bet that way and what the thesis was that caused us to bet that way. But the simple answer is, as a hedge fund, we're able to take advantage of betting that the market would go down, both stocks and bonds, and that's what we did.
So you were betting that stocks, you shorted stocks and you shorted in bonds, and I imagine you must have done it to a quite large size.
Yes, we were pretty aggressive. When the opportunity set is big, we bet big, and I believe that the opportunity set was big, and as it turns out, it turned out to be correct, and the market cooperated with the thesis that we had.
The market definitely cooperated with your thesis, and stocks and bonds sold off together, which, as you know, is very rare. In fact, the negative correlation between stocks and bonds is part of the reason why investment advisors put a lot of people into the 60-40 portfolio, 60% stocks, 40% bonds. Diversified stock and bond portfolio does so well so much of the time. Why did you go against that and sort of take a thesis that was a direct attack on the 60-40 portfolio? What gave you such confidence?
I suppose it dates back, even a decade prior. Both stocks and bonds rallied together. So, everybody likes to point out that the 60-40 model failed on the downside, but it actually worked quite well, anomalously well, when markets went up. So as you said, historically, stocks and bonds have been somewhat negatively correlated, but for 10 or 12 years prior, we actually saw bonds rallying, interest rates coming down and stocks rallying at the same time. So, and so one has to think about what was the reason for that. And the reason for that, in my opinion, and I'm fairly confident about it, is one reason and one reason only. And that was the $25 trillion of liquidity that the global central banks injected into the system, an ocean of liquidity, initially in response to the global financial crisis and later on in response to the COVID-19 pandemic. And, the collateral effect of that, the initial collateral effect of that was massive asset price inflation. So nobody can tell me that having $19 trillion of sovereign debt trading at negative nominal interest rates, Germany, for example, German bonds traded at negative 70 basis points. Nobody can tell me that that's normal in a universe and explainable and rational. Nobody can tell me that it's rational or explainable or normal that the global economy should screech to a halt in response to the pandemic, but yet the stock market goes up like a rocket ship. That's just not normal and explainable and rational. Nobody can tell me that it's rational or normal that the proliferation of certain NFTs, trading at $69 million. I'm referring to people or things like that is a rational occurrence. But yet this is factual. These things happen, and so we have to think about why did it happen. And so public equity valuations, private equity valuations, $19 trillion of sovereign debt trading at negative nominal interest rates, NFTs, 18,500 cryptocurrencies, the SPAC boom. These are all different stripes of the same zebra, the zebra being the $25 trillion of liquidity injected into the system. And when you inject $25 trillion into the system, you're going to get a collateral impact of that. And the initial collateral impact was massive asset price inflation across the board. So as you said, both stocks and bonds and cryptos and rare, Rolex watches and baseball cards and, NFTs and Dogecoin and anything you want to point to was the beneficiary of that tremendous amount of liquidity infusion. And, unfortunately, the secondary collateral effect of that liquidity infusion was consumer price inflation around the world. It took a long time for that to develop and to become seen. But prior to recently, consumer price inflation is somewhat of a unicorn. It's something that anybody under the age of 60 maybe has heard about, but really hasn't experienced in their lifetime. And it's become we're hearing about this thing called consumer price inflation, but is it extinct? Does it really exist? We haven't really seen it, at least in the U.S. Elsewhere around the world, there is consumer price inflation in certain countries. So the secondary collateral effect being consumer price inflation, that is something that's central. Whereas the central banks are not trying to kill bull markets in general, they don't care if there's a bull market in Solana or there's a bull market in Dogecoin or CryptoPunks. But what they care about is that if there is consumer price inflation around the world as a result of the ocean of liquidity they injected into the system, that's something that they have to address. And that's the bet that we made, that they would address it by reversing 180 degrees their posture towards liquidity, going from liquidity infusion posture to a liquidity extraction posture. And so it's logical to believe that if you believe that markets rallied and did what they did simply because the central banks injected enormous amounts of liquidity into the system, and that provided a tremendous tailwind for all asset prices, it's very logical to believe that as they extract liquidity in an effort to rein in inflation around the world, that that would provide a tailwind against asset prices of all stripes. And that's exactly what we saw. We saw stocks go down, we saw bonds go down, we saw cryptocurrencies go down, we saw NFTs go down. Everything that basically was the beneficiary of the ocean of liquidity has started to come down. And this, just like it was a multi-year process to add in the liquidity, over a period of 12 to 14 years, central banks added in the $25 trillion of liquidity. Extracting that liquidity will also be a multi-year process that began, last year in earnest. The Fed just started to allow $85 billion a month of bonds to roll off their balance sheet starting in September of last year. And the ECB, the European Central Bank, will start allowing 15 billion euros per month to roll off starting upcoming in March. So this is just a process that has only started to get underway, and I believe will provide a headwind against all asset prices in much the same way that the liquidity infusion provided a tailwind against in supporting all asset prices.
Neal, the argument that central banks are going to remove liquidity, this will be a huge headwind for assets. In retrospect, it seems obvious because you were clearly right for 2022. But you've been in, I'm a young guy, so I feel like young people can say, "Oh, central banks are going to do this. I'm going to go very short." But I feel like you've been in the industry in a long time, and people who make very large bets because they think central banks will not support asset prices haven't done well. Let's just say over the past 15 years or 20 years. I mean, going back to Greenspan. So yeah, I mean, I feel like over the course of your career, you must have seen people take bets saying, "Oh, there's no way the Japanese Bank of Japan can do this. There's no way that your yields can't go negative, right?"
Right.
But they did. So what gave you such confidence that this was the one? This was the one time that things would really fall, and central bankers would allow a huge repricing across all assets.
Sure. So as you said, historically, it's been very difficult to make money from being a bear, from the bearish side. Most people have made their money on Wall Street being bullish. And as you alluded to in Japan, they don't call the trade of trying to short Japanese interest rates the widowmaker trade for no reason. So it is a more difficult trade. I am a trader. A lot of the people that you allude to and that we know about in the markets are portfolio managers, so they have to make large bets and they kind of have to sit with it no matter whether the market price action is confirming their thesis or not. So I had the luxury of being able to wait until the trend of the market started to confirm the fundamental thesis that I had. And ultimately, the price action is the Bible. And so when markets are going down, and when we started to have a downtrend, and I had the fundamental thesis in place, although I didn't play it aggressively until I got confirmation from the price action in the market that both stocks and bonds, which is what I chose to play in. I didn't short cryptos or anything like that, but I could have. But when I got confirmation from price action that the trend was pointing down, everything sort of aligned. So I had the fundamental thesis along with the price action where markets were in a bear market, supporting it. And I was able to bet very aggressively when I had those conditions in place.
And when did you get that confirmation? I think the stocks peaked maybe November of 2021. And I remember January 1st, they were near their all-time highs, but they dropped like a stone and bonds fell. So yeah, walk us back to early 2022, maybe late 2021, when you had a thesis, you were sort of dipping your toe in the water. I think I'm right, and if I'm right, this could be big, but I don't know if I'm right. What was the process of you getting confirmation and your conviction going up to place this bet on very large?
Sure, that's a good question. So we launched the fund in April of 21 with this fundamental thesis, recognizing that the price action hadn't yet supported the fundamental thesis that we had, that I had. And so I traded throughout 2021 very cautiously. In fact, not much at all, actually, because the S&P, I believe, was up roughly 27% in 2021. So, as a trader, the old adage of cutting your losses quickly, or, again, like I said, price action is the ultimate Bible here. If it's just not working and I'm not getting satisfaction, I'm not a glutton for punishment, So if I lose money and I try to make some short positions and it doesn't work out, then I'm going to stop, maybe come back again and try again a little bit later. And if it still doesn't work, I'm gonna stop doing that. So in the year 20, we did launch in April of 2021. I really can't publicly disclose performance information, but let's just say we didn't lose, we didn't make, broadly speaking. So 2021 was a year that the price action really didn't confirm the thesis, the fundamental thesis. So as a good trader, because not only does one have to have the right thesis, but one also has to, that's sort of the white collar part of the job. The blue collar part of the job is actually the trade implementation and managing the risk, and knowing when to step on the gas pedal a little bit harder, and knowing when to take your foot off the gas pedal and put your foot on the brakes. That's all part of the trading aspect of the job. So we really didn't have confirmation that the thesis was playing out, at least the market wasn't confirming this until very early in 2022. And really, as you said, the peak was right around the beginning of the year. And, markets started to sell off. And it's not just looking at trends and trend lines. I mean, in a very technical way, I'm just more of a, qualitative type guy. But, just looking at the price action. How does the market respond to good news? How does the market respond to bad news? The momentum of the market, versus how it was trading in years prior. Does it have the same energy to the upside, or does it have different energy to the downside? So it's somewhat of a qualitative assessment, having been a trader for 33 years, that the market was just trading a bit different, and so we went with it, and nothing reinforces more than satisfaction. So we were getting satisfaction, and we were winning to it, so we kept going, and ultimately the trends started to develop in our direction.
Right, and without revealing your special sauce, what was it about the price action that you identified? And you also said something really interesting about how the market was reacting to news. So if a stock market rallies on bad news, that's a sign the stock market wants to go up. If it sells off on good news, we might be in a little bit of a bear market. Tell us about that. And then what were the news items of the day? I think inflation. Unfortunately, I'm trying to pull it up now. It was rising.
I mean, there's always inflation numbers every month. There's always economic information. I don't recall any individual piece of news that I responded to. But as you said, if a piece of news is bullish, and we all know, when news is bullish, right? If inflation is better than the market expects, or employment is better than the market expects, whatever, that might be bearish for bonds, bullish for stocks. We all know what bullish and bearish indicators are. But as you said, it's the market reaction to that. So, if in my history, based upon a piece of information, if the market should be up 10, let's just say, I'm being hypothetical, and it's actually up 8, that's a piece of information that tells you something about the stature of the market at that time. that maybe the bulls aren't in complete control and that there's selling pressure underlying the market, which has caused something that technically, theoretically, this is all qualitative assessment, but should be up 10, instead it's up 7 or 8, and so that's sort of a little hint to tell you that, hey, I've seen this pattern before. It really should be up 10, but it's really not up that much. It's kind of telling me a piece of information as to who's got the control in the market, whether it's the bulls or the bears. Conversely, if just to stay with my example, if something should be up 10 and it's up 15, then we know that, maybe the market, the balance of power at that moment is better buyers, for whatever reason, short covering or people getting long or people being aggressive. So always looking for that demand supply equation in the market between buyers and sellers to determine, who's got the balance of power, whether it's the bulls or the bears, and, again, if the piece of information is mildly bearish, but you get a major reaction to the downside on it, that's also a piece of information. So it's not always exactly what the information is. It's more often how the market responds to that information that's the more relevant aspect of it. And
in January and February, what was the Federal Reserve saying? How closely were you paying attention to them? I think they were tapering, had not done quantitative tightening yet. They did not hike interest rates in January, but I think they indicated that they would in March. So the spot interest rate of Fed Fund Rate 0 was basically at 0, but the 2-year was going up because it was pricing in these cuts. And then, the 10-year, the 30-year, they were selling off as well. So yeah, what were you sort of noticing in the bond market, and how did that relate to your thoughts on Fed and inflation?
Right. So for years, I've been on guard to note that, the liquidity infusion that was injected into the system was always meant to be a temporary situation. The central banks had tried on numerous occasions to withdraw that liquidity because they're not in the business necessarily of influencing the market to such a great deal. The market should be a free market where private buyers and sellers have price discovery that's uninterrupted by global central banks. So that's the more natural condition. So I was always on guard for when the Fed would, or global central banks would reverse course and try to extract the liquidity that they had added to the system, unnaturally influencing prices and causing some of the collateral effects. I suppose the most startling one being $19 trillion of sovereign bonds trading at negative interest rate, negative nominal yield. So you actually had to pay the government to own their bonds, which is just an unnatural condition. But so the central banks know that, and they were, there was always going to be a time when they were going to extract it, and they got interrupted from doing that because of the COVID-19 pandemic. And not only were they not allowed to do that, they actually had to add more liquidity to the system to help support the financial system during the crisis times. And so I think it was early in 2021. Maybe February, that the Bank of England was one of the first ones to say that they were going to start selling off some of their corporate bonds that they had purchased. I mean, it's just unnatural for a central bank to be buying corporate bonds. I mean, this is something that a private sector should be, private investors should be buying the debt of corporations, not a central bank. So the Bank of England had said that they were going to sell their corporate bond portfolio, which I think was about $20 billion, which is not a lot in the global scheme of things. And that was sort of the canary in the coal mine to start me thinking that, okay, maybe the central banks, now that we're past the worst of the COVID-19 pandemic, we're certainly, many years past the global financial crisis, maybe the central banks are going to start thinking similarly, where they're anxious to start allowing the market to be a more freely tradable market that has natural price discovery, unlike it was where they were so involved. So I was very much on guard for looking for hints from the central bank. And then eventually, and I'm not sure exactly what the timing was, but they did announce that, central banks around the world announced that they were going to be normalizing their balance sheet is what the term that they use for that. And normalizing it was that they were going to cease buying, fixed income securities, and they were actually going to let certain amount of fixed income securities roll off. Now, central bankers, in general, move slowly, but also don't want to cause any, massive market disruptions. They don't want to cause a market crash or anything. So, they announce it, they move slowly and methodically to make sure that the markets can handle that, the economy can handle that. And, seems like COVID-19 started to get a little bit better in terms of at least its lethalness. And certainly people are still dying from it. But the initial, lockdown on the global economies around the world started to ease a bit, where people were sort of getting back to work and life was getting somewhat back to normal. And so the central bank started to normalize the balance sheet. And I believe that, when you get the biggest buyer in the world, not participating in the market any longer, it's natural to expect that prices are going to fall. And they did. So I just kept going with it. It's as simple as that. Ultimately, it affects all asset prices. Obviously, the central banks weren't buying cryptocurrencies and letting those roll off. Their vehicle of choice is bonds. But when bonds start to roll off, and that has to go be absorbed by private sector, there's less liquidity to buy more speculative things like cryptos and NFTs and even stocks. So it has a spill-on effect, just in the same way that it had an effect when they were injecting the liquidity into the system. They weren't buying cryptocurrencies, but it filtered in initially through purchasing of the bonds, which provides investors with money. That money gets divided up in many different ways and ultimately finds its way into some more speculative aspects of financial markets, including the private equity space and venture and all kinds of stocks and other securities.
Even though stocks and bonds both sold off in 2022, I've heard, and I think it kind of seems to me that the sell-off was of a slightly different nature. In stocks, it was something of an orderly an orderly sell-off where, okay, we'll all get in line, we'll all sell. Where in bonds, it really seemed like there was a true panic, a sort of a cascade of liquidations. Is that fair to say? How would you differentiate the market conditions between those two markets? I'm obviously talking about prices, but volume, liquidity, sort of bid-ask spreads, willingness of dealers to do deals. Did you get the sense that people were saying, I need to get out of this market at whatever price? Or were they saying, oh, maybe I'll take a little bit of risk off?
I think in general, both the stock market sell-off and the bond market sell-off were fairly orderly. In the bond market, you actually have something that to hold on to that's supposed to anchor bonds, whether it's downside or upside, and that's the federal funds rate. So as the federal funds rate was being, that doesn't directly control the stock market. The stock market can still go up, even if the central bank is raising the federal funds rate. But it's hard for interest rates. If the overnight rate is 4.5%, 5%, it's hard for the 10-year note to be 50 basis points. So there's as the overnight rate goes up, because why would anybody buy 10-year bonds if you could buy it at 50 basis points, if you could buy 1-year bills at 5%, and then it also goes to funding costs and things like that. So there is somewhat more of a basis for why the fixed income, at least the sovereign fixed income markets trade the way they trade. They're very much tied towards central bank movements of interest rates. But in general, in terms of the trading activity, I can't point to any individual day or any individual week where there was a crash, per se, and it was extremely disorderly, at least in the products that I trade, which is mostly the sovereign debt, as opposed to corporate bonds or mortgage securities or other types of bonds. But my understanding is everything was generally pretty orderly.
Hey there, sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto. Some own crypto. A smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code GUIDANCE10. Thanks, and let's get back to the interview. let's move forward from January to you started noticing that shorting everything it's a trade that's working. So you do more and more of it, and that trade continues to work all the way, I think, till June. And I think June 15th was June 15th or 16th was the first time that the Federal Reserve hiked by 75 basis points. But paradoxically, even though after that week you had a sell-off, that was the beginning of the first real moderation or rally, bear market rally, I guess we can call it, from June all about to Jackson Hole. So I imagine because of the stellar returns that you had, not only were you right, but you must have sort of delved in and delved out and navigated that bear market rally ably. So yeah, tell us about that when the price action was briefly, for a few months, moving against your thesis.
Sure, those were challenging times, and there were a few episodes during 2022 when the S&P rallied, maybe 500 points from the low point to the peak before resuming its downtrend again. And again, I'm a trader, and a trader needs to certainly we got hurt during those periods. Not a fortune teller, but a trader needs to have certain risk management that when the market is going against you, you lighten up, and even to the possibility of just getting flat. We weren't long the market because it was against the thesis that we had, and it was against the longer term trend. But during those very vicious counter trend rallies, some of the biggest market rallies in history come as counter trend bear market rallies. And so in short periods of time, meaning some of the biggest up days that we've ever seen happen during these counter trend rally periods. So I have to be very vigilant as a trader to cut losses quickly when they occur. Only in hindsight we see how far it went or how fast it went. So when you're living it real time, there's not an exact science to this. But I think we did a decent job of cutting our risk when it was going against us, taking some losses. But then when the market was turning back in our favor, our performance was positively skewed. So which means that we made more money when markets were in our favor than we lost when markets were going against us, and that really speaks to risk management and trading talent.
Mm-hmm. A few more bear markets, a few more rallies were to continue. Like October had a remarkable month, and then we right now are in the middle of a rally that began shortly after the December FOMC meeting, the Fed meeting. What have you made of the recent price action, and which has moved against the short everything trade? And how are you weighing the risks and rewards right now?
Sure. So just in 33 years trader, nuance feel that the buying that's gone on this year primarily is sub short covering, but there's also some real money buying in the market. There's real money there's real people getting long here. Unlike a lot of the rallies that you alluded to last year during the bear market, were sort of the types that were vicious counter trend rallies, short covering rallies. A lot of people who were short, maybe the macro guys, the CTAs, people that were underinvested, whatever they may be, were scrambling to buy the market, and those felt like aggressive counter trend short covering rallies. This year feels a little bit more like, obviously there's some short covering going on, but there's also real money buying. And whether those people are going to be right or not, I guess their thesis is that we're getting towards the end of central bank tightening cycles, that inflation is coming down. People are betting that it will continue to come down to lower levels, to levels that are acceptable to the point that not only will the central banks stop tightening, but the market is actually pricing in easings at the moment, that economic activity will become so depressed, and inflation will become so depressed that later this year the Fed is, let's say in the U.S., the Fed is not only going to stop tightening, but they're going to start lowering interest rates. I don't share that belief, but that's what makes a market. I'm betting that those people are going to be wrong. But again, I have to respect the price action above all else. The market is telling us something, and I have to listen to what the market is telling us. I don't have to buy into it and be long, but I do have to be much more cautious in terms of establishing aggressive short positions when the market is just not supporting that view. I have to respect the market. I have to be, I have to have no ego to suggest that I'm right and the market is wrong. I do still believe that the larger thesis is central bank liquidity is really what is the most important aspect of the game here. But that's a long-term game. That's not something that may play out in a quarter or even possibly in a year. And I have to make returns and protect capital for my investors on a much shorter time scale. And so I have to respect what's going on in the market. And to me, that translates into being a little bit less aggressive until the price action dictates that I'm right again. I do believe that I will be right again, and I do believe that the markets will turn down, both bonds and stocks and a variety of other products. But right now, the market is rallying, and the market is always right, even if it's just right for the time being. The market is ultimately the arbiter of right and wrong. Like I said, the price action is the Bible.
Price action is the Bible. Price action is king. Neal, you talk about liquidity and balance sheets, and I think quantitative tightening is incredibly important. But it's very hard for me and amateurs just to observe the balance sheet, whereas enthusiastic people can just from their house explore the bond market and the terminal rate and the forward rates curve. I think the terminal rate peaked out a little bit above, so the highest point that the market is pricing that the Federal Reserve will hike to, peaked out a little bit above 5%, which is where it was in the dot plots in December. But then since then, the terminal rate has been going down. So the absolute level of monetary tightness as determined by rates has been going down since November. And the pivot, the cuts have more cuts have been being priced in as well. So we have two cuts being priced in for 2023, many more being priced up in 2024. And I also think, just as a amateur observer, that a lot of the correlation between stocks and rates has been very high on the positive side. That is, if the 2-year jumps 20 basis points, that's not a day where stocks will do well. So yeah, how have you been examining the relationship between the 2-year or between rates and stocks? Like, would you think it's fair to say that a large part of the stock market rally is because of the easing of rates?
Yeah, I mean, sentiment tends to be risk on or risk off, at least during the most recent periods. Today, this is February 3rd. We got the employment report today, and it was a huge upside surprise, up over 500,000. And I'm watching the market, and bonds are selling off, and stocks are rallying. So, which I suppose in theory should be logical. If the economy is doing well, stocks should rally. And the bonds are telling you a little bit that, maybe there's not going to be as much easing as we had thought. So the market is always sort of, as new information comes to light, the market is always weighing things differently. Each day, like when we get a surprise like today to the upside of employment doing very, very well, at least as the numbers suggested today, a little bit of that enthusiasm for rate cuts down the road has come out of the market, at least on this 1-day basis that we're talking today. Everybody talks about the terminal rate, but it's a little bit of a silly statement because it's never really terminal. It might be terminal for like a month or 2 months. I don't know. And maybe talk peak rate is better because the market is suggesting that we're going to hit that rate and then we're going to start going down. But the market is usually the pendulum swings too far to one side or too far to the other side. So the market is that's what allows for speculators to make profits when when the fundamentals or when the reality diverges from what the market is anticipating, and a speculator gets that right, that provides a profit opportunity for the speculator. Of course, it also provides an opportunity for the speculator to lose money. But so I would bet that the central banks, and this is what they're telling us as well, that rate cuts are off the table. They're not going to be cutting rates for this year. The market is saying, we don't care what you say, Mr. Powell. We're going to believe that the economy is going to get so weak and inflation is going to come down so aggressively that, yes, you are going to cut rates. And so, whether the Fed is going to be correct, ultimately they hold the cards. They can do what they want. But, the market is historically a pretty amazing weighing machine that, is the collective wisdom of, millions of participants all over the world, some of whom own the businesses directly or have direct information on their businesses as to whether they're able to raise prices. And maybe the market is telling us that, those people that own businesses around the world and who are senior executives in major companies around the world are just not able to raise prices, and they're seeing it before the Fed is even seeing it. So we just don't know. But, that's why for someone like myself, I have to, I have a view and I have a fundamental thesis, but I can't stick to it that dogmatically because, the price action just doesn't dictate it. So the best scenarios for me to profit, which is why we made so much money in 2022, is when my fundamental thesis and the price action coincide with each other. So right now I've got, a certain fundamental thesis which is not being supported by the market price action, and I have to be much more timid in my my approach because I have to respect that price action.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. How are you thinking about the economy? As you said, we're recording on Friday, February 3rd, where we just got a major beat where over 500,000 jobs were added. The unemployment rate in the U.S. is now 3.4%, causing some to say that the health of the U.S. economy is strong. Do you agree with that? And how does that affect your outlook on your shorts of respective stocks and bonds? Because if the economy, if we plunge into a deep recession, I imagined your short on stocks may do quite well, but your short on bonds may not, and vice versa. So what do you think about the economy, and how does that affect your outlook on stocks and bonds?
Sure. So I'm going to say two things. One is I'm not in the prediction business. I'm in the observation business. Anybody that is in the prediction business, I feel it's a silly business to be in. I feel like it's either incredibly naive to think that you can predict, too far in advance. The foreseeable horizon, maybe 1 or 2 months. Beyond that, so many variables are going to occur, that over the 33 years that I've observed, people that are trying to predict the world and how incredibly wrong people are and how incredibly wrong the consensus is, I've decided that it's just not a business that I want to be in, is the prediction business. So I'll tell you that all I can do is observe what's going on as the information comes to light. And today we had strong employment. We've had initial jobless claims. These are observations. These are facts. These are not speculation. We've had initial jobless claims under 200,000 the last 3 readings in a row. That was followed on by a strong employment report. So at this very moment, it doesn't seem like the employment picture is weak at all. We have a 3.5% unemployment rate. I remember when people used to think 5% was full employment. Now we're at 3.5%. So certainly the employment picture, I understand that there's a big divide there's certain people that are certainly struggling and not employed, but broadly speaking, taking over the entirety of the economy, we're doing pretty well and that's an observation. It's not a prediction. I don't know how the future is going to go. But there's nothing that I can point to that's going to suggest that it's going to change that in any material way. I'm not in the being right business. I'm in the money-making business. So my investors don't pay me to be right on the economy. They don't reward me for being right in my predictions. They reward me for making money in the form of incentive fees and or in the form of certain management fees by giving me money to manage. And so I don't mind if I'm dead wrong and I make money. That's what my fiduciary responsibility is to my investors. An economist their job is to try to be right. And if people want to listen to economists, that's fine. But my job is not to be in the being right business. My job is to be in the money making business. And so that doesn't mean I can't have a thesis that I'm thinking about and looking to see if the market confirms that thesis. But I have to be much more of a trader, and I have to, be following the price action and worry about things like making money, as opposed to having an outlook that I have to stick to, come hell or high water.
Do you think it's fair to say that stocks are pricing in something of a soft landing where inflation will continue to fall and earnings will grow at a modest pace and definitely won't decline? I know you said you have a stronger view on stocks and bonds than you do on the soft landing, recession, but asset prices must be reflecting some sort of prediction about the future, right? And so what do you think that prediction is right now?
Well, I'm observing what, like I said, I'm not predicting, I'm observing. The market is pricing Goldilocks. I mean, the market is pricing that we're going to have a soft landing and that we're towards the end of, this inflationary episode that we saw, that the central banks are going to be, maybe have one more modest rate hikes and that's pretty much it. And then they're, going to be forced to reduce interest rates because inflation will be so under control that there'll be no need to keep rates at the levels at which they peak at, some people call it the terminal rate. And that the economy will not tip into recession. I mean, and that's why the S&P is in the same spot as where it was basically in May of last year. So we had all this tightening, from the first tightening on, as you alluded to earlier. The S&P is basically the same spot as it was when the Fed first started tightening interest rates. So again, that's not a prediction; that's an observation. And so it's factual that the market is pricing Goldilocks. Now, whether the market is going to be right or it's not going to be right, that remains to be seen. That's a prediction that I don't know and nobody else knows, quite frankly. Not even Jay Powell doesn't know. He's just following along with information as we're receiving it. But based upon something like, recent jobless claims and today's employment report, it does seem like the economy is fine. Based upon recent inflationary indicators, it does seem like inflation is coming off. It's certainly not coming off to the level yet that they would like it to be. The market is anticipating that it will, and that is a prediction. And whether that rings true or not will be adjudicated by the market in the months to come as we see new information continuously come out of the market. My thesis, is more related to liquidity in the market, and as opposed to central bank movements of the overnight interest rate or the movements of stocks at the moment. In much the same way that there was really no fundamental reason that could be justifiable as to why global economy screeched to a halt during the COVID-19 pandemic and the market shot up like a rocket ship, or that $19 trillion of sovereign debt traded negative in terms of you had to pay governments to own their bonds, and that was really a function of the amount of liquidity that was sloshing around in the system, added by the central bank. So my thesis is much more related to the movement of that liquidity by the central banks, and that's a long time period where you're going to get rallies like we're getting now, and you're going to get sell-offs. But I just don't think that the next 10 years will be resembling the previous 10 years when we had the liquidity infusion that we had, and now we have the liquidity extraction. So on a shorter term basis, which is people looking at things on a 6-month, 1 year, 3-month basis, whatever it may be, clearly the market is pricing a soft landing and a dramatic reduction of inflation, a ceasing of rise in interest rates by global central banks, and in fact, lowering of interest rates down the road.
I feel like there are two definitions of liquidity. There's central bank liquidity. Are they expanding their balance sheet? Are they reducing their balance sheet? And then people combine it with the Treasury General account, and they make all sorts of these equations about, is liquidity high? Is it low? Is it rising? Is it falling? But then there's being in the market liquidity of, I want to sell a large amount of assets, and my ease with which I can enter and exit positions is either large or small. I either have to pay a large fee or a very small fee. When liquidity is ample, I can get in and out no problem. When it's not, I have to pay dearly. Are you noticing that both of those definitions, when you were just talking about liquidity, we're using only the central bank one, only the market one, and to what degree are they related? Because you see both.
Yeah, sure. So I was really just talking about the central bank one. It would be interesting maybe for your listeners to pull up a chart of M2 money supply versus the S&P. So M2 money supply has a very high correlation to the movement of the S&P. And now M2 money supply is coming down quite sharply. And, to me, that's a bit of a leading indicator. But that speaks to more of a government liquidity. Liquidity in the market, you're talking about the market microstructure and how the market functions, the health of the market functioning, the health of the system, the stability of the system, of the financial system. And, it has surprisingly been quite smooth. It's gone through its episodes of a little bit, less liquidity. But at the moment, that tends to happen during bearish market environments, or rapid sell-offs, like March of 2020. There was some liquidity issues in the market during that time, and the central bank stepped in and helped the market function a little bit better, and it worked. But basically, the market right now is functioning very well, and people are generally able to move in and out of large blocks of securities, with the normal amount of slippage that they would normally incur based upon how much they're moving. So market liquidity, I think, is okay, as you would expect. The market is quite stable, and it's not in a panic sell-off in either stocks or bonds. But the liquidity that I'm really referring to is more central bank liquidity and central bank's balance sheet.
Thanks, Neal. On whatever time horizon you want, you can choose which are you more bearish on, stocks or bonds, and why?
It's a good question. I would say that I don't know. I think that probably bonds, because bonds are anchored. Stocks can kind of do anything. They can, S&P can go up to 5,000 or 6,000 or, whatever. It's pretty hard to rationalize, let's say 10-year Japanese interest rates, which I think are around 38 basis points, when the Japanese inflation rate is running at 4%. Even if the Japanese inflation rate were running at 2%, it would still be hard to justify 10-year JGBs, Japanese government bonds, trading at 40 basis points. So, there's a somewhat more rationality associated with bonds. I don't know what the most recent readings on inflation are, but Fed funds, it's in the 4, 5, 6%, whatever it is, 6% in the U.S. But we have 3.5% 10-year notes. So, you're someone, if inflation were to just stay where it is currently, you would definitely have a negative, 200 and something basis point return, real return. So that's not rational. It's just not rational that people are going to invest for a negative real return. And so the more natural condition is that there is some positive spread. There's some level of real interest rates, meaning a real return, meaning after inflation, people are getting paid to invest their money. And that's the much more normal historical condition. And so based upon where inflation is today, and even in a rosy scenario, if it comes down, the pricing structure of the fixed income markets across the world is, to use the academic term, wackadoodle.
While we're using academic terms, do you think this rally is a sucker's rally?
I believe so. My thesis is gonna remain, intact until something dramatic happens, and maybe the central banks say not only are we gonna stop letting our balance sheet roll off, but we're gonna start buying bonds again. Then obviously I would have to reevaluate the thesis. So I think that ultimately, a lot of people are very focused on Fed policy and inflationary pressures and that sort of thing. I'm focused on what I think is a much more longer term issue. It would have been interesting and very appropriate, if you always have economists going on TV, whether it's Bloomberg or CNBC, and over the last dozen years, and the reporters always asking, well, what do you think about inflation? What do you think about we had this inflation number. What do you think? Someone would have said, doesn't matter. I don't care. Central bank is adding liquidity, buy the market. And what do you think about the employment report? The employment report just came out, a week. Doesn't matter. I don't care. The central bank is adding liquidity, buy the market. What do you think about the COVID-19 pandemic? The global economy screeched to a halt. Doesn't matter. The central banks are adding liquidity, buy the market. That's it. And that's really all you had to know, because that was the story. All of the vagaries and all the movements associated with economic activity and all the minutia that people were focused on for the last 12 years amounted to one thing, and that was the market just went straight up, essentially. Every time there was a dip, you bought it. Every time the market, and you stayed long, and that's a function to me of central banks adding liquidity. So now, as central banks are extracting liquidity, to the extent that they continue to extract liquidity, it's basically the polar opposite, where none of this stuff really matters in the big picture. It just creates trading opportunities where, doesn't really matter what happened with employment or inflation. If the central banks are extracting liquidity from the system, sell the market. That's it. But I can't just do that, without risk management, because I'm a trader and I have to make money for my investors. So I can't just stand in front of a freight train.
Right. Yeah. And it goes without saying, any guest on this program, it never gives investment advice. But I just want to underscore that, you are a veteran of the business who is entering and exiting positions, constantly risk managing. No one who's listening to this to say, this guy, had this XY return, having this thesis, I should do this. Everyone is responsible for their own risk. So with that disclaimer, Neal, we've been talking about stocks and bonds as a monolith, but do you have any view on steepeners? Because you said the 10-year go to 5 or 6%. In that scenario, is the spot rates still at 5%? Or is it at 7 or 8%? Because if it's the former, then that curve would re-steepen. Likewise, you mentioned the Japanese JGB market, government bond market. Are you more bearish on that than American stocks? How would putting on a trade like that affect your view on the yen dollar, which you may not want to have a view on?
Sure. So I am betting on a steepener at the moment. It does seem like the central banks are nearing the end, at least pausing. They call it the terminal rate, or I prefer to call it the peak rate. We don't know. It's only a peak until there's a new peak after that, if there is one. It could be the peak rate, but it seems like the central banks, are nearing that end. But yet the long end of the curve, so the 10-year sector, let's say, is not really reflecting, the thesis that I have yet, that, as liquidity comes out of the system. So the short end is much more tied to central bank influence versus the longer end, which is much more tied to risk assets in general. If markets are selling off, the long end will whip around, more consistently with risk assets. And so I am betting on the curve steepening. The Japanese government bond at 38 basis points it's also wackadoodle. The problem is, the Bank of Japan is very, very strong central bank. They're very well capitalized. They own, something like 100% of all the JGBs. So, that is a very, very controlled market. In fact, they don't make any, they're not shy about even saying that it's not. They call it YCC, yield curve control. So they are actively in the market buying the 10-year JGB anytime the current ceiling for that is 50 basis points. They have a new central banker who's going to be starting there to replace Kuroda. I think it's April. And I think Kuroda is just kind of, Japanese protocol might, suggest that they allow the new guy to shape investment policy in the new guy's vision. So he's probably not going to do much. It hasn't done much. He didn't do anything at the last Bank of Japan meeting, although they did raise the ceiling and allow JGBs in December to rise from what their previous high level rate was 25 basis points. They allowed it to go to 50 basis points. But then in the most recent BOJ meeting, they didn't do anything. So I do believe that they're going to gradually try to normalize, their 10-year rate to be more consistent with the global economy, because otherwise, it's just out of line, and it sets up this tremendous carry trade that exists where people borrow in a country where it's cheap, to borrow in terms of interest rates, and invest in higher yielding countries, and that has an impact on the currency. But since I'm not really trading currencies, I'm not that involved in that. But there is somewhat of the Central Bank of Japan has to be aware that they have to move their interest rates more in line with the rest of the world, especially since their inflation is running at 4% now, and they were trying to get it up to the 2% target, and we've surpassed that. So, maybe they'll allow, as the new guy takes office, they'll allow the yield curve control to widen the band a little bit.
Yeah, let's end there. Best of luck with the trade, and thank you everyone for watching.
Thanks so much.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.